Many people in the US postponed their retirements because most of their money was into equities. And in this time when the markets are so volatile, how important it is. While the stock markets fell by 10%, I continued to get this interest rate on my bond funds. And then I used some of my bond funds and I invested into the stock market. So I gained both ways. The Nifty 50 index fund has given me 127% annualized return in the last 1 week, and the Nifty 200 momentum has given me 154%. How it looks? It has only gone up, and how you can take advantage and actually make more money than having all your money into stock markets. Learn about these 4 things, and guaranteed you will make money, reach your financial goals. It's a win-win having debt funds. Welcome once again to my channel, where you will learn tips, tricks, and gain your knowledge on personal finances. And not just personal finances. Here you will also learn how to grow your relationship. Harmony and money. Yes. This is my new book, and my paperback hard copy is out, published. You can check out Amazon. So today we have a very exciting topic. This is not about stock markets and shares, but something that is connected to this, where you can learn how to make money, not just from stock markets, but also different other kinds of mutual funds. And that's what we will cover today. The debt mutual funds, and how you can take advantage and actually make more money than having all your money into stock markets. Yes. So I'm going to talk to you 4 important things today. Take time, be a little patient, wait till the end, learn about these 4 things, and guaranteed you will make money, reach your financial goals, take advantage of the volatile stock market, and also some other government policies that will benefit you. So very interesting. Wait till the end. I'm going to cover, as I mentioned, I'm going to cover 4 things. And if you're new to this channel, I'm Frankie Fernandez. I am a certified financial planner, and I'm also a relationship or marriage coach. For me, it is not just making money which is important, but also your important relationships. What's the point having great wealth, but not having family members with whom you can share and enjoy? So do not neglect either of them. And that's what my book is talking about. I have more than 30 years of experience in the asset management, that is the mutual fund industry. And I'm an author of 3 books. I have written 2 books on marriage and 1 on money and marriage. Let's get into today's session, and I'm going to take you through these 4 things. So take your pen, your notebook, and preferably sit together so that as a family you can learn and empower yourself and implement it in your life together. So there was a time when most Indians, सब भारतीय जो थे, वो फिक्स्ड डिपॉजिट में निवेश करते थे. Everybody would invest in fixed deposits or postal savings. Then in the last few years, especially post-COVID, we have seen many young investors investing in equities. बहुत सारे जो नौजवान हैं वो सब equities में इन्वेस्ट कर रहे हैं. Equities market, stock market. एक तरह से अच्छा है कि people have moved from fixed deposits into equities, because equities is the engine for the growth of your wealth. I've talked this often in my videos. It's an engine. Equities ही आपको बहुत प्रॉफिट देंगे. Equities ही है जो वो एक ट्रेन की इंजन की जैसे हैं. वो आपको खींच के लेकर जाएगी. आप जब निवेश करते हो, आपकी जो पूंजी है, आपकी जो वेल्थ है, वो बढ़ाने के लिए equities is the best. Equities will help you reach your financial goals, your long-term financial goals. Equities will help you grow your wealth. Equities will help you get financial freedom early in life. But the problem is that These days, all the young folks, especially, invest everything into equities, and that is a problem. And this is what I have addressed in my video on allocation. It's called misallocation of assets. So asset allocation is extremely important. तो आप ये वीडियो देखिए, इसमें मैंने बताया है व्हाट इज एसेट एलोकेशन, क्या होता है एसेट एलोकेशन, और इससे क्या फायदा होता है हमको. So what are the advantages of asset allocation? It's very important, because if you put everything into equities, it's a problem. So today's video will not be about equities, but how you can take advantage of the equity markets also, at the same time take care of your portfolio, take care of your emotions, and how to continue to gain long-term wealth. It's a win-win having debt funds. It's a win-win having debt funds, and that's what we will look at it. So as I said, there'll be 4 things we will look at. So let me begin with the first. What is the first thing that is so important, and why you should have debt funds? So debt funds, or fixed income funds, or bond funds, which you call them, they are not volatile. They are not volatile, or they are less volatile in the short run. And it is so important. Let me share with you, what do I mean by this? Now look at this debt fund. It's a short duration fund from Axis. So if you look at the last 1 year, how it looks, it has only gone up, and it has given 7.8% returns. If you look at last 6 months, it looks straight with the slight curves, with slight deviation. 1 month, you can see lightly, but keeps going up. 3 years, straight line. 5 years, almost a straight line, right? And I'll come to, in my 4th point, I'm going to talk about in detail about the slight variations, why they happen, and how we can take advantage of them, right? But now if you look at it, it's a straight line. It keeps going up. But if you look at an equity fund, a small cap fund, how does it look? This yellow is the category average. That means all the small cap funds, this is the average. But Quant has done better. Now this is not, my objective is not to talk about Quant small cap. There are a lot of small caps which are good. But here I'm just trying to show you, what does volatility mean? Now this is, let's take 1 month. It has come down. It has gone up, it has come down, it has going up. If you look at 3 months, see how it looks. And in fact, it has come down. 6 months, it has gone up and slightly come down. But you see how it looks. So many curves, so many curves. This is the meaning of volatility. And in the last 1 year, it has gone up, slightly come down, but you see how ups and downs. Now, how does this help? Why is it that a debt fund which goes straight is helpful, and it is not volatile? Why it is helpful? It is simple. You can't have all your money into equities and you see them going up and down, right? There are disadvantages. You also should have something in your portfolio which is stable. Let's take an example. In your career, all of us love to have some good projects, exciting projects, where we work a little, work day and night. We are excited. We talk with our colleagues, we talk with our bosses, talk with our clients, working on some coding, some programming, or some project. What happens? Exciting. But just imagine, if you have this kind of an excitement every day, every week, every month, what is going to happen to you? It's going to affect you emotionally, mentally, and physically. You also need some work which is stable, where you can, a few months, maybe 1 or 2 months of volatility is fine. Then you need a career that is stable, where you can go on vacations, where you can go to work on time and come back on time, right? You need that. Anything in your relationships, there will be some volatility, but most of the times you need stability. It is very important. Same with investing. If it's only volatile, although in the long run you will get, but if it's only volatile in the short run volatile, it will affect you, especially if your risk profile is low, if your risk profile is conservative. अगर आपकी रिस्क प्रोफाइल, अगर आपने की है रिस्क प्रोफाइलिंग आपकी, हर कोई जो है, जो इक्विटीज में इन्वेस्ट करता है, निवेश करता है इक्विटी मार्केट में, ये बहुत जरूरी है कि आप आपकी रिस्क प्रोफाइल जानिए, whether it is conservative, moderate, aggressive. So depending on your risk profile, if your risk profile is low, you cannot see a lot of this volatility. The more it's volatile, the more you will be volatile in your emotions. You cannot see that. Not everybody can see that. और लॉट ऑफ द यंग फोक्स नो, काफी सारे जो जवान हैं हमारे, यंग लोग जो हैं, उन्होंने इन्वेस्ट किया और उनको उनको ऐसा लगा कि सिर्फ ऊपर ऊपर जाएगा, लेकिन इन द लास्ट 2 months वी हैव सीन इट इज कम डाउन. सो वॉलिटिलिटी इज नॉट ऑल द टाइम गुड, and there are other reasons I'm going to talk about shortly, but you need some stability and some volatility. In fact, my own portfolio, as I mentioned, always, I have, at my age, I've got 60% and a little more into equities and 40% into debt bond, that is stability. And it's so important to see this stability, because this has gone down by 10-12%, my equities in the last couple of months, but this is grown. So that brings stability. And in my video on asset allocation, I'm talking about it. Asset allocation means maximize your returns, minimize your risk. So that's why bonds are an important part of your portfolio. So do not reject or do not throw away debt funds. Yes, a little bit of fixed deposits is important for your emergencies, but a lot of the others, stable portfolio should be into debt funds. And I'm going to talk about a few debt funds here, not a lot. This video is not about primarily to talk about a lot of debt funds, which I'm going to talk about later, but this is what are the broad advantages, and in this time when the markets are so volatile, how important is a debt. So this is the number one advantage of a debt fund over equities. Very important. Your asset allocation should have enough debt funds. A rule of thumb: if you are 30 years, you must have around 25 to 30% of money into debt. Simple. The rest 70 will be into equities, right? This is rule of thumb, but you cannot apply this broadly. I have explained in my video, in my asset allocation video, how your asset allocation should look, right from 30 to 40 to 50 to 60, right? Please watch that, right? So this was number one. What is number two? So number two is liquidity for financial goals. Now this is a very, very important part. This is a very important point, especially if you have financial goals too close. So watch my video. I'd done this video several months ago. Financial goals too close. So in this video, I have explained clearly that when you have financial goals too close, for example, you want to buy a house, you want to make the down payment, or if you want to, for your children's education, आपके बच्चों की फीस के लिए अगर आपको पैसे चाहिए, तो अगर 6 महीने और 1 साल में अगर आपको कुछ few lakhs of rupees if you need, your financial goals are too close. What do? You cannot have equities. Just imagine if you have to pay fees in October for your children's fees. Incidentally, I had to do that. Equities were down and you can't do that. You cannot withdraw from your equities. It will be a big loss. तो आपके लिए बहुत नुकसान हो सकता है अगर आप जस्ट विड्रॉ कर दोगे आपके इक्विटी से. You cannot do that. So what you need to do is you need to have enough money into debt funds, right? So if your financial goals are too close, for example, we are in October 2024. In October 2025 or maybe in April 2025, if you have to pay fees, in fact, I have to pay that for my second daughter. What should I do? I should ensure that I must take out from equities and keep it into debt funds. Very important. And there are a few different types of debt funds. I'm going to talk about one or two in my fourth point. But these debt funds, from here, you can then put into equity fund. What happens here? From now till April, for example, the money that I put into a debt fund, for example, a couple of lakhs, maybe 2 lakhs, if I keep it in this debt fund, it'll only keep growing till April. In the next 6 months, probably it'll give me 4, 5, 6% returns. right? It'll give you better returns than fixed deposits, but at the same time, no volatility, very less volatility. I don't have to worry that in April, what happens if the market falls? But if my money is into equities, I don't know what is going to happen in April. In fact, you watch my video, there I've also mentioned the same thing. Market is looking good. It is at the beginning of this year I'd done, probably in March, April. And I'd mentioned there that markets are looking good now, but if the markets do not keep growing, keep going up, what happens? So I've clearly mentioned that. So here it is so important from debt, and then later on you can put into a liquid fund, maybe close to March, April. But this journey from here till April is very, very important. And that is the advantage of a debt fund. A debt fund will help you stay stable. And this money you can use for your financial goals. It could be, for example, your retirement. अगर आपके retirement हो रही है, आपकी उम्र, for example, right now maybe you're in your 30s, 40s, but when you're retiring, in 2008, many people in the US postponed their retirements because most of their money was into equities. और जब markets गिर गए in 2008 Lehman crisis, they could not retire. वो काम नहीं छोड़ सके, वो रिटायर नहीं हो सके क्योंकि पैसे नहीं थे उनके पास. जो भी पैसे थे वो सब इक्विटीज में थे. All that was into equities. So they had to postpone. So friends, it is very important for you to have enough money for your financial goals, whether it is retirement, whether it is your children's wedding, children's fees, or you want to make the down payment for your home. All these are financial goals. When you're reaching the financial goals, you cannot take out your money when it is volatile. So if you're on a ship, you cannot come out of the ship in the middle of the sea where it is, right, stormy. You have to come to the shore where it is stable, and there you can come down. Same way with your financial goals. So you have to be having enough from this journey till your financial goals. You must have enough debt which will help you stay stable. And it will give you the liquidity. You don't have to worry. It has happened with me many times, especially once my kids have grown. वो बड़े हो गए हैं, उनकी फीस के लिए जब पैसे चाहिए, मैं इक्विटी से नहीं निकालता हूँ. ये सब मेरे डेट फंड्स में होते हैं. And I am not worried. I'm not worried about the fees. I'm not worried about the near future because my money is into debt and it is gradually growing every day. And I'm going to talk to you kind of returns the debt funds also give. That was number 2. Now number 3. So point number 3, to have debt funds in your portfolio. Investing opportunities during falling markets. This is a very, very important point which I have experienced many times in my life. If you watch my last video on gaining long-term in falling stock markets, I did make a mention about this, that in 2020, one of the things I did was I moved from debt funds into equity funds. I took advantage. And when I did that video, my previous video, I did make a mention, and actually, that is the time when I actually invested. मेरे पिछले वीडियो में मैंने बताया था कि मैंने 2020 में मेरे डेट फंड से मैंने इक्विटी फंड्स में डाले थे पैसे, और वही सेम चीज मैंने वही बिल्कुल वैसा ही मैंने अभी किया, अभी कुछ पिछले दिनों में. And it was so advantageous. And let me share with you where I invested and how much I gained. Now, this is Nifty, as I'm referring to the Paytm Money app, and this is the Nifty where we see that the markets 28th October, it was here. In fact, 3 months ago, the peak was 26,000. That is in September of 26, and then it kept coming down here. And here, when it was November, when it was very clear that the markets are not going to come up very soon, then the sentiments are low, sentiments are down. So at 19th November, I invested in 2 index funds. One is the Next 50, and the other fund was Nifty 200 Momentum Fund. Both these funds, I invested some money just to see. I was very cautious. I didn't know. Maybe the markets would fall down further, I thought. But I invested. I already had some money invested in those funds. So उन दो फंड्स में मेरे पैसे थे पहले से ही, तो मैंने फिर से पैसे उसमें इन्वेस्ट किए 19 नवंबर को। और क्या हुआ? टुडे, एज ऑफ टुडे, द निफ्टी 50 index fund is 120 has given me 127% annualized return in the last 1 week, and the Nifty 200 momentum has given me 154% annualized returns. That money which I invested. Now just think about it. Could I have invested if I did not have enough money in debt funds? Could I have made that bold decision? What if all my money was into equities? What I would do? I'd be very careful. I will not invest more money. I will not invest my extra cash or my from my salary or from my income. I will not invest because I'd be scared. What if this also goes down? Unless I'm doing an SIP or unless I'm doing it for long term. Now, even this money which I invested was for long term. ये long term के लिए था. तो मैंने क्या किया? मेरे डेट फंड्स में 40% वॉज इन डेट, तो मैंने क्या किया? वहां से निकाल के थोड़े पैसे मैंने इक्विटीज में डाले, ये सोच के कि अब मार्केट्स नीचे है, मार्केट्स काफी गिर गए हैं, तो अब मैं अगर निवेश करूंगा तो आने वाले दिनों में मे बी 3-4 सालों में ये जो मैंने इन्वेस्ट किए ये मुझे ज्यादा रिटर्न्स देंगे। अभी ऑफ कोर्स in the last 1 week it has given me 127 154%. I'm not saying that will continue, but this money which I moved from debt will give me good returns. Now think about it. If I did not have money in my debt funds, could I have taken this advantage? No, it would have been impossible. But because I had enough cushion, I invested into the equity funds. Now this is a very big advantage of a debt fund. To do your asset allocation, do your portfolio rebalancing. When your equities, my equities were 60% and 40% was debt, but equities started going down because of this 10% hit. And my debt was obviously going up because it is not volatile, it keeps going up. I could take money and invest it here and rebalance my portfolio. So this is the number 3 advantage. And now we go to number 4. What's number 4? So the point number 4 is interest rate cuts, bond prices rise. Now, this is a very important characteristics of bond funds. And this will be a little technical, but I want you to pay attention because this is something, a part of your financial literacy, which you can remember it for your lifetime and take advantage from bond funds or take advantage from debt funds. So before I proceed, I just want you to understand ये चीज जो है आपको, आप अगर समझ लोगे तो आपको आपके जिंदगी भर जो निवेश करोगे डेट फंड्स में आपको बहुत फायदेमंद होगा। तो ये जानकारी बहुत जरूरी है आपके लिए। सो वेरी इंपॉर्टेंट फॉर यू। सो रिमेंबर वन रूल ऑफ थंब, whenever interest rates fall, generally the interest rates, the bank rates, right, the FD rates, whatever, the bond prices, the debt funds, they go up. And there is a logic behind it. So we won't get into that right now. Probably I can explain it. Let me know in the comment box. Do you want me to explain the relationship between interest rates and bond prices and how it can help you? So let me know in the comment box. But for this video, I want to keep it very simple and less technical. But I want you to understand the importance of interest rates. Remember that bond funds or fixed income, they all give you returns based on interest rates. And interest rates are decided by RBI in India, Reserve Bank of India. And interest rates going up, down is a part and parcel of the economy. And they're all connected to the inflation. So inflation right now is 4-5%. Interest rates are around that, around 6% or so. 6 or close to 7%. So interest rates go close with they go hand in hand with the interest rates, the bank rates, what RBI decides. The RBI meets and decides on the rate. The goal of RBI is to control inflation. And that is where all the interest rates come into play. And now what is currently happening? Currently, the inflation is around 4 to 5%. And whenever inflation comes down, RBI also brings down the rate. In 22-23, the inflation was up globally. So to control the inflation, government increases the interest rates. Very simple. This happened across the globe. In 2020, when the markets were down because of COVID, to revive the economy, because the interest rates, because the inflation also had come down, to revive the economy, the government brought down the interest rates. Inflation was down, interest rates were down, right? And then later on, the inflation started going up, going up, going up. The interest rates started going up. The government started increasing the interest rates. Now, what happens with bond funds? As long as the inflation is stable, interest rates are stable, you get the same returns. In FDs, you may get, for example, 6%. Bond funds, you may get 7%. A little risky bond funds, you may get 8% or whatever. That is the way it happens. But the moment inflation changes, government changes the interest rates. And that is where it mostly, and this is where the bond funds get affected. So, and when the bond funds get affected, it affects your returns on the bond funds. In 2020, I'll just show you a chart. I show you some news items. What happened in 2020, 2021? Because the inflation had fallen, what did the government do? They brought down the interest rates. The moment they brought down the interest rates, the value, market value of the bond funds or the bonds went up. And that is where wealth was created in bond funds. Let me share with you. So this is an article about bond funds, the best corporate bond funds to invest in 2021. So this is an article in 2021. And I would like you to see this, the returns on these corporate bond funds. 1 year return, 7, a little higher than fixed deposits. But 2 years returns, 3 years returns, you can look at these. 11.56, 10.71, 10, 9, 9, 9. These are compounded, which means they are the annualized returns. Interest on interest. Close to some funds, 11%, 12%. How could they give? This is because the markets were going this and suddenly they went up. The bond funds were going up and the interest rates, government, the RBI brought down the interest rate. Suddenly, the bond funds returns jumped. And this is what happened in 2021, 2020 and 2021, because the government actually brought down the interest rates. Government ने interest rates को कम कर दिया. Government ने interest rates को कम कर दिया क्योंकि inflation कम था. So government ने interest rates को कम कर दिया to revive the economy. मतलब economy में कोविड की वजह से इकोनॉमी गिर गई थी, जीडीपी कम हुआ था. सो उसे रिवाइव करने के लिए गवर्नमेंट ने इंटरेस्ट रेट्स को कम कर दिया. क्योंकि कम हुआ वो बॉन्ड फंड्स, जो ये थे बॉन्ड फंड्स, उनकी रिटर्न्स बढ़ गई. सो दिस इज व्हाट हैपेंड. एंड देन व्हाट हैपेंड? देन the interest rates, the inflation started going up. The government started increasing the interest rates, the RBI. Right? That is when the bond funds were not good. Their returns fell. Exactly the opposite happens. But now, in the last more than a year, RBI has been successful in bringing down inflation. So the inflation has come down to again 4. From 7, 8%, it has come down to 4, 5%. But the interest rates are still up 6, 7%, 6% or so, around that. Now, when the government brings down the interest rates, what will happen? Bond funds will suddenly give you high returns. In fact, in the last few months, this has been happening. And some of the bond funds have really given phenomenal returns. And there's an article I'm going to show you from Economic Times, which says that government, RBI, is going to reduce interest rates, which means further the bond funds will go up, the returns will go up. Let me share with you a bond fund that I invested. And in fact, the market talks about it and what returns we have got. So let me share with you the article. So this is an article on November 25th, 2024, in Economic Times, and it says RBI set to cut rates soon. Which debt mutual fund should you invest in now? Right, and it has got. So here it shows how the interest rates have come down. 1 year, 3 years, 5 years, 10 years, 15, 30 years. So 1 year ago, current yield and 1 year change. 1 year ago, it was 7.12 and it has come down to 6.81. So if you see, the blues are high, the yellows are low. Yellows are the current yield. So these 1 year, 5 years, 3 years, 5 years, these are the duration of the bonds, which means how long the bonds are, which means when the money is given to the government or to the company, when will be the maturity. So higher the maturity, higher the duration, higher the returns. So here is the Wealth magazine from Economic Times, which is distributed every Monday. And here it says, which debt fund is for you? A very good magazine. If you get a hold of it, please read this. But let me just quickly share with you, how we can take advantage of this. So here it says, which debt fund is for you? Experts believe the RBI will cut rates next year. Find out what this means for debt funds. So what is going to happen to debt funds? This is what is the story about. And if you look at it, talks about different types of debt funds: short-term funds, medium-term, long-term, dynamic bond funds. Now, I'm not going to get into each of these. If you want me to make a video to talk about these debt funds, let me know in the comment box. Would you like to know more, where I can simply explain? Instead of you reading and understanding, I can actually explain to you in few minutes in a short video. Now, here it talks about these funds: short-term funds, medium-term, best long-term, dynamic bond funds. Now, I have been consciously investing because I know the interest rates are falling. So in the last 6 months, I've been investing. And one of the funds that I invested was the Nippon India Nivesh Lakshya. There are other bond funds also. And it shows 11.57. I've also got around 11.56% in the last 6 months. While the stock markets fell by 10%, I continue to get this interest rate on my bond funds. And then I use some of my bond funds and I invested into the stock market. So I gained both ways. So now here it shows 11.57. And this is, these funds hold very long-term bonds, can shoot up if rates are cut. Suitable for the long term and for investors with higher risk appetite. Now, these are the different funds. As I said, I can't go into each of them, but long-term funds will actually jump from 11.57. They can even become 13, 14, 15% for that short period when the interest rates are cut by the RBI. So RBI जब भी ये interest rates को कम करेगी, तो ऐसे फंड जो है ना, बेस्ट जो लॉन्ग टर्म फंड्स है, इनकी रिटर्न्स जो है वो बहुत बढ़ जाएगी. Already 11.57%, and I had invested, and it is given almost the same. And now I'm just waiting for the next year, because the bond funds are the safe funds, less volatile. I don't have to worry if they will fall or whether they will go down. They won't go down. They will now, because of the interest rate cuts, they only will go up. So I have actually invested. So this is a great advantage for you. If you have done your asset allocation, if you have funds available to invest, say for the next 1 year or so, you have financial goals, there is nothing better than these bond funds, dynamic bond funds, short term, medium term, long term. Of course, there is higher risk in these long term funds. Talk to your advisor and then only invest in these. But if you invest in these, you may get very good returns in the next 1 year. So I would say, if you have got financial goals next year, probably good bond funds are the best thing for you. Let's read each of these. Like short-term funds, these are funds if you want to invest for the next few months. want to withdraw, these are the best funds. These are not very sensitive to interest rate changes. Go for these if your investment horizon is 1 to 2 years. Yes, but if you have money which you don't, next 6 months, 1 year, these could be the best. Medium term funds, they hold bonds of slightly longer maturity, so changes in interest rates will affect them. Suitable for investment of 3 to 4 years. So if you see all these are all less than 5 years. 5 years and above, you must invest in equities, but less than 5 years, hybrid funds and bond funds. Maybe someday I can talk a little bit about hybrid funds. So these are the 4 benefits of bond funds. ये चार advantages, अच्छी चीजें बॉन्ड फंड्स के बारे में. तो आपने अगर निवेश नहीं किया है बॉन्ड फंड्स में, this is the best time. As I said, what are the 4 things? Number 1, what are the advantages of debt funds right now? They are not volatile or less volatile. They keep going straight up. There's very little up and down, unlike stock markets. There are advantages of having less volatility. Liquidity for financial goals, right? When you have financial goals coming up in the next 6 months, 1 year, if you have bond funds, you can convert them into cash or liquid cash or liquid funds very soon without worrying because they are not so volatile. Investment opportunities during falling markets. As I mentioned, when the markets are falling, actually you can move from your debt funds into equities and take advantage long term. Yes, there are some tax implications, but ultimately the gains from equities is much higher. And finally, the interest rate cuts, bond prices rise, right? So these are the 4 advantages. So these are the 4 distinct advantages right now with you. So you must think of investing in bond funds. So आप ये 4 चीजें हैं जो आपको फायदेमंद है आप अगर बॉन्ड फंड्स में इन्वेस्ट करोगे. So these are the funds. This in the long term, this will help you build wealth. So it's a win-win for you. Please remember that asset allocation is extremely important for us, and bond funds actually offer that compared to fixed deposits. FDs, when the interest rates go down, the FDs also will go down. The interest rates, the current FDs, right? Maybe your existing FDs will continue with maybe 5-6%. Unlike bonds, the more the interest rates go down, the bonds will go up much higher. So that is the advantage because they are connected to the market. So I hope you have got some understanding about the debt funds. If nothing else, you can just ask your advisor and ask and invest in a long duration or a medium duration or any bond funds which have duration around 2 to 3 years. Definitely you will get good returns, very high returns because of the interest rate changes. And this doesn't happen every year. It happens every few years, maybe 3-4 years. So this is a golden opportunity. Don't miss it. I hope you liked this video. If you watched till this moment, I'm sure there is some learning for you. Please let me know if you learned something new about debt funds. And out of these 4, which ones are very important for you? Trust me, as a young family, if you're in your 30s, 40s, very important for you to have some debt funds because of your upcoming financial goals. So have some, especially in your 30s, you can have less, but in your 40s, you should have more. And so अगर आपकी उम्र अगर 30 साल है तो एटलीस्ट 20 to 30% तो आपके पास होनी चाहिए डेट फंड्स. पर अगर 40 साल के हो तो एटलीस्ट 40%, 40 साल के एटलीस्ट 30 to 35% तो आपके होनी चाहिए डेट फंड्स में, क्योंकि आपके फाइनेंशियल गोल्स आने वाले हैं कुछ ही सालों में. सो इट इज वेरी इंपॉर्टेंट फॉर यू. और इन दिस वॉलेटाइल, when you don't know, markets will go up, down, it's always good to have some money in debt funds. And as I mentioned, now in the next year, the interest rates will go down and the prices of bonds will go up, your returns will go up. So thank you for watching. If you like this, please give a thumbs up. If you have not subscribed, I recommend you, I encourage you to subscribe, and please comment if you liked it, didn't like it, what you learned, how you're going to invest based on this video. Let me know. If you have any questions, technical questions, or if you want me to do an in-depth video on debt funds, let me know. Do not ignore debt funds. That's my message. So it's a win-win for if you have debt funds. So thank you for watching. Have a great day. See you soon.